It's the Real News Network. I'm Sharmini Pires coming to you from Baltimore. A new World Bank report titled "The Changing Wealth of Nations Compared Economic Growth Among Different Regions in the World Since 1995." It found that sub-Saharan Africa has suffered from stagnation and even a loss of wealth, while wealthy OECD countries became even wealthier. One important issue that wasn't discussed in the World Bank report is the issue of corruption and its economic effects. We are going to take that issue up with our next guest, Leonce Ndikumana. He's a professor of economics at the University of Massachusetts Amherst and the director of the African Development Policy Program at the Political Economy Research Institute, Perry. He's also a member of the UN Committee on Development Policy. He co-authored the book, Capital Flight from Africa: Causes, Effects, and Policy Issues. I thank you for joining us, Leonce.
Thank you very much for the opportunity.
So, Leonce, an important dimension of the wealth that the report does not address is Africa's wealth that is stashed away in secrecy in other jurisdictions as a result of accumulation of capital flight over the past decades. And recent evidence of this could be found in the Paradise Papers that was recently released about how the famous wealthy and rich people in the world stash their money in various places to avoid tax. And in this case, I guess when it relates to Africa, this applies as well. So tell us about how the report evaded that issue.
I think this is a very important point that you are making. First of all, just to remind our audience that this report is about measuring countries' wealth across the world, which is an innovation from the traditional practice of focusing on income. And that distinction is critically important because when we are measuring, as the World Bank decides to measure wealth in addition to measuring income, it allows us to see how countries are utilizing their resources to create wealth. But it also allows us to examine the sustainability of growth, because wealth creation uses resources. So it allows us to see how countries are utilizing their natural resources, their human capital, to create wealth. Now, that's important because then it allows us to examine a number of things which are really not emphasized in the report. One is how that wealth is distributed, both among countries and within countries. So if you go beyond the income, which has been used to measure inequality and distribution, and consider wealth, then you will see actually that according to the evidence that's being produced, and also according to the evidence on wealth stashed abroad that I'm going to touch on, you'll see that the traditional view that inequality between African countries, say, and the rest of the world is going to change, in the sense that the wealth that's stashed in offshore financial centers in developed countries outside of the continent is not accounted for by these measures. Okay? So that means that these measures are underestimating the wealth of Africa because they are not counting the wealth that has been exported to safe haven, secrecy jurisdictions, and the international financial markets. So, which means that the gap between wealth in African wealth and other regions may be actually smaller than it is being measured. Within countries, not counting wealth which is stashed abroad creates, again, biased measures of inequality, because if you are only looking at income that's generated in the country or wealth that's generated and held in the country, ignoring the wealth that's stashed abroad, you are likely to underestimate the inequality within country because the rich, the elite, have wealth which is not showing up in national measures. And that wealth belongs to them, which means that they are much, much wealthier than the ordinary citizen, than national official statistics will tell us. So it basically says that we have wealth that's concentrated typically on the top, the very, very top, which is not in the books that the governments and the international institutions are reading to measure national wealth. And that's where our analysis of capital flight comes into play. But I wanted to make that clear, that the measurement of wealth, which is an extension of our measurement of progress by using income, is actually a major step ahead that's going to allow us to look at both sustainability of growth in the long run, but also get a much clearer sense of inequality that's not only focused on income, but also includes wealth. And one other thing about why we need to look at wealth when we measure inequality is because wealth allows you to hedge against or absorb shocks over time. If a household has a lot of wealth and there's a shock to their income, that means that during the recession, during the shock, they can actually survive by drawing on their wealth. Your ordinary citizen in Africa who depends on either salaried labor income is not going to be able to absorb the shocks because they don't have the wealth. So again, measuring wealth allows us makes us see actually that the gap between the wealthy and the poor is much, much larger than we would have anticipated by looking at just income.
And what are the implications then on inequality as a whole as a result of this?
Yes. So first of all, again, between countries, the wealth I'm talking about, which is stashed abroad, is actually fueling the economies of the developed world, because the financial systems where this money is held in London, New York, the Bahamas, and all that, that is money that's being used as capital for the development of the developed world. In a sense, African countries are actually financing the development of the developed world. It's a paradox. It's really, really bad in the sense that we are accustomed to hearing that the rest of the world is supporting Africa by providing aid, by providing foreign direct investment. But actually, this evidence about this massive amount of wealth stashed abroad means that, in contrast, it's African economies that have been fueling the developed world economies. Our own estimates thus far show that from 1970 to 2015, the accumulated amount of capital flight from African countries is in excess of 1.5 trillion. Okay, that means that it's bigger than the current total GDP of African economies. That money could have contributed to capital accumulation in Africa, to development by financing public investment, social service delivery. That money is lost to African economies. And I want to underscore this point. Even developed countries suffer capital flight. But most of the time, because the capital stolen or stashed abroad away by the wealthy, actually cycled back into developed world economies through the financial system. The money that arguably is held in Panama, in Bahamas, in Cayman Islands, is actually intermediated in the banks in London, in Paris, in New York, and so on. So it actually fuels the economies of the developed world. It's a very ironic situation where the countries that are capital starved, which are developing countries, including African countries, are the ones that are exporting capital to the rest of the world. That means that the poor is financing the rich. It's really, really unacceptable. then within countries, that means that we know that the capital flight benefit from the elite, because they are the ones who are able to acquire the capital through either their own earnings, but also by embezzling national wealth. These include political elite. They are the ones who are able to evade the law, often through corruption, and they are the ones who have the connections to get the money out of the country and stash it away from the countries. And here, the African countries are facing an uphill battle, in the sense that this phenomenon is made possible by the complicity of the international financial system. These banks are receiving money that's coming from developing countries with no questions asked, even though there are rules on the books that require banks to ask what we call due diligence, know your customers. Those rules are not implemented, which means that that makes it possible for this capital flight to go on unabated. And so the whole discussion about capital flight, offshore financial systems, implies that the discussion of capital flight and how to curb it is not just an African issue. It's a global issue, because even if, as people say, African countries manage to clean up their house, it's not going to stop capital flight until the banks where the money is being held, the countries where the money is being invested in real estate sectors, are willing, and their governments are willing to cooperate and support African governments in identifying where the money is going, and freezing the money and repatriating it to the country. Another dimension of how capital flight and offshore financing affects inequality is by undermining the provision of public services. So basically, the money that's being stolen and stashed outside of the continent is money that could have generated a tax income, tax revenue for the government, and therefore financing public service delivery like education, health, and so on. That means that the poor are not able to access schools, healthcare, and other services, because there is not sufficient financing for those services. And ironically, the elite, which is benefiting from capital flight, is able to basically source those services elsewhere. You'll find that the elite in African countries send their kids to school in Europe, in the US, and other rich countries. They are able to source health services abroad. The poor is not able to do that. So that's an aspect of inequality that we don't get to measure when we only look at income.
All right, let's turn to corruption and the plunder of the African resources. Of course, it has domestic implications and global dimensions to this corruption. Elaborate on that for us, finally.
Yes, so our analysis so far has shown that the phenomenon of capital flight is facilitated by corruption on both ends. Corruption at the origin, at the source, and the corruption at the end, which I alluded to when I talked about the lack of transparency, the lack of accountability in the banking systems in where the money is being stashed. But at the source country, it's the corruption that prevents enforcement of the rules of law, enforcement of the rules about capital transfers, that allows the elite and the powerful to be able to smuggle the money abroad and, first of all, acquire the money without any accountability. So it means that there is when we talk about how to curb capital flight, how to prevent further capital hemorrhage of African countries, there is one important factor is to strengthen institutions, both domestically but also internationally. So, but the challenge is this: if you are in a country with bad institutions that are facilitating capital flight, how do you change those institutions? Because the same people who are in charge of those institutions are asked to reform themselves. You don't ask corrupt institutions to reform themselves. That means that we have to think about a coalition, a global coalition against capital flight, against corruption, with the support of foreign entities, foreign government, foreign civil society groups, who are going to support domestic populations in Africa, civil societies in Africa, the academia in Africa that's trying to voice their concerns about this phenomenon, because we cannot keep saying let's encourage African countries to go look for more aid. Let's encourage African countries to create a better environment for foreign direct investment. When money comes in and more money is leaking out of the country, out of the continent, that's not helpful.
All right, Leonce, there's so much more to go into with you about this issue, which I hope we get to do on another occasion. I thank you so much for joining us for today.
Thank you very much.
And thank you for joining us here on the Real News Network.